Good afternoon, everybody. At least it's afternoon here in One Mile. Thanks for your attendance at this, which is my very first webinar for FX Street. Today we're going to talk about the Aussie dollar. It's at the crossroads, where it is at the moment, where it's going to go. But to do that, I need to give you a little bit of history, and I'll give you a little bit of history about myself too, so you know who I am and what I. Back in 1983, when they floated the Australian dollar, I was 14 years old and I saw this fellow Peter Chan on television and decided that's what I wanted to do. So I was lucky enough that by the time I was 18, I was in the Westpac dealing room in Sydney at head office, and since then I've traded short-term interest rates, managed cash, bond and FX portfolios, been a currency strategist and also a bank treasurer. I live 200 k's from Sydney though, and it's pretty hard to have a traditional career in finance, so I've set up my own financial services company, Lighthouse Securities, but also I'm launching in the next week or so my own FX website, which is called globalfx.com.au. We've taken the firewall off it for the next day or so if you want to have a look, you can have a look, and we'd appreciate any feedback. Just quickly, that's me and my family. This is where I live, and if you look really closely, you can see me on my ride-on mower there. This fella here, he's one of our neighbours. He lives out the front. This is our beach, and that's the sand dunes that seem to go on forever. So it's a pretty nice place, and got a wonderful lifestyle here. But anyway, before we go on, I just want to quickly talk about my process when it comes to foreign exchange. It's really my process when it comes to any market when I'm evaluating. It's very simple, but also a little bit complex. Essentially, what I like to do is I like to build from the ground up, but also to have a global overlay. An overlay that pretty much drives, the key macro themes or the key global themes. This process was handed to me by a fund manager at BT back in 1999, a fellow by the name of Doyle Mallet, who, when I gave him my view on the Aussie, said, "Greg, that's really good." I was working at Westpac. I was the first currency strategist in the country back then. And he said to me, "That's great, how do I take it to my asset allocation team?" And that was pretty telling, because I thought I was pretty smart. So basically what I like to do is look at the key drivers built up from the variables underneath it. Things like, the commitment of traders, speculative positions, interest rates, commodities, lots of different things when we're talking about the Aussie. There's probably 100, 200 different drivers in there, and I distill that into my key drivers, then I have my decision rules and I implement. The beautiful thing about this process, and you'll see why I'm talking about this as I work through, the beautiful thing about this process is that I call it time invariant, it's kind of fractal. Whether I'm talking to a corporate wanting to hedge out into 2015, or I'm talking to a spot trader who's just only interested in the next minute, 30 minutes or hour, I can use the same process. Obviously the drivers that I use might change and the weightings that I give those, but overall the process is the same, and whether it's the Aussie or the Euro or any other currency, it's the same process. So, a little bit of history. Aussie's been floated since 1983, back in December. It was essentially done to give the RBA more control over monetary policy. What we did was we took the variability out of the internal economy via interest rates and placed it into the currency. Since the float, it's traded 47.75 up to $1.1080. 47.75 was April the 19th, 2001. I was lucky enough to, back in 1999, myself and Richard Trenialovich, who's Westpac's currency strategist in New York now, we decided we thought the Aussie was going under 50 cents. We weren't allowed to write it. The chief economist at Westpac at the time wouldn't let us. I subsequently left and went to NAB, and I was allowed to at least say I thought it was going to the low 50s. But on that day I put out a paper saying that the Aussie was going to bounce 10 cents, and it did, so that was pretty good. One of the most important things when we look at the outlook is the RBA prefers a clean float. And the fact that it's liquid for most of the day pretty much is one of the reasons why, and I think also because if you go into any dealing room in the world you'll find an Australian, and we do like to punt. The Aussie is now the 5th most traded currency in the world. So since the float we've had a great big old range. Lately it's been a bit different to what it has over the first 27 or 28 years of its float, and that has caused some difficulties for the Australian economy. But one of the things that obviously we're going to talk about here is what's changed, and something has fundamentally changed. On the charts going forward, you'll see a lot of orange lines, and I can trace what has changed for the Aussie to those orange lines. So I'll talk about that in a little while, and we'll show you what has changed. But let's have a look at the 5 drivers. These are the 5 most important things for the Aussie. Global growth and commodity prices. Well, that's fairly straightforward. We all know that. CRB goes up, Aussie goes up. CRB goes down, Aussie goes down, whether it's copper, which I'll show you a chart of. The Aussie's always been a growth proxy. But if that was the case, you'd probably argue that the Aussie should be lower than where it is now. Domestic growth and interest rates. This is important as well. Obviously, currencies are what I like to call least ugly contests. People put money into Australia because they're taking it out of somewhere else, or it's seen as a better risk-reward trade-off. This is important in the current environment. It's always been important though. If you map the Aussie with the US 2-year spread, you'll see a pretty good correlation with the Aussie-US. If you do the same with Euro, and if you do the same with some of the other crosses, you'll see that interest rates are fundamental. Now, why is that? When I was at Morgan Grenfell, one of the things you clearly used to do is you used to have to make your case as to why the other fund managers would allocate out of the US or the other dollar block countries, as it was then called, and put the money into Australia. And largely it was about interest rates and the potential for capital gains. One really important thing to note, I think, is that global fixed income managers, so managers who manage global fixed income funds, use interest rates as an excuse to take currency bets. Now, I don't want to put too fine a point on that, but the capital gain comes from their currency bet more often than not, and this is really important. Now, obviously, as a growth currency, risk appetite is clearly really important. You know, risk appetite, risk aversion. Every time the market's gone off for the last 20-odd years, the Aussie's been smashed. Whether it was back in the Asian crisis, whether it was after the dot-com crash, 9/11. More recently back in 2008, where it fell all the way back down to 59.60. That doesn't seem to be the case anymore, and we'll talk about why that is in a bit. Technicals, of course. If you're going to have a currency that's traded as much as the Aussie dollar, then technicals are clearly going to be important. Much of this conversation today is going to be about fundamentals, but I never do anything without looking at my technicals as well. I was lucky enough to be trained by a fellow who used to do the old point and figure by hand, and he got me onto John Murphy's book a long, long time ago, and the Asian crisis taught me that for whatever reason technicals do tend to work. And of course the US dollar. Back in 1998 when I became a currency strategist, I put the US dollar into my Aussie dollar model. No one had ever done that. I couldn't quite understand it, but it's the much underappreciated driver of the Aussie. It really is just the other side of the coin. So let's have a look at Aussie and commodity prices. I'll use copper as my proxy, and you can see there, the chart on the left, 1986 to 2001, Aussie and copper did pretty well. But then, in that late 90s period, Aussie really underperformed copper. Now, what was going on there? We'll get to that in a sec. On the other side, you can see that Aussie has reacquainted itself with movements in copper and commodity prices more generally once again, until about April-May 2011. And you'll see that orange line come through a lot. One of the things that happened back in the late 90s was that people saw us as old world, and I'll talk about that a little bit more. RBA and commodity prices. Once again, Aussie's been rallying recently as the RBA commodity price index, similar with the terms of trade, whatever you want to use. It's been a good proxy for the Aussie dollar pretty much since China joined the World Trade Organization in November 2001. That was one of the big changes for Australia. It meant that the old rocks and dirt suddenly became important, not only on a global scale, but also for the Australian economy. We've obviously had mining booms Mark 1 and Mark 2, and we're just washing off the effects of Mark 2 now. One of the best indicators, though, for me, because currencies are always a relative bet. They are, whether you buy Aussie versus US, or Aussie versus Kiwi, or Aussie versus Euro, you're effectively selling one to buy the other. So one of the ratios I like to use is the MSCI Metals Index versus the total global index. That gives me a ratio of the performance of mining shares relative to the index. This was one of the reasons why back in 1999, Richard and I figured out that we thought that the Aussie was going under 50 cents. It was mainly because we were just seen as old world. This has worked really well up until recently once again. In that April-May region of 2011, the metals performance has fallen, but the Aussie has stayed strong. Equally with interest rates. As I said, interest rates are a key driver in my toolkit, and you can see that as a proxy, that the Aussie-US 2-year spread has worked reasonably well. One of the things that you'll notice back on the left-hand side of that chart when the Aussie was down under 50 cents was that there was no pickup at all if you wanted to be in Aussie dollar assets out of US dollar assets. Now, if you're a manager of a global fixed income fund, that makes no sense. You're taking currency risk for no return, and on account of that, then you just simply put your money elsewhere. You keep it in US dollars, which is your base index if you're a dollar block investor, or you put it in Kiwi dollars or something like that. And back in those days, Kiwi interest rates used to be much more volatile than Australian, and they're always much more fun to trade. So you know, that's one of the reasons why interest rates are such an important part. It's also one of the reasons why understanding in the current environment why the Aussie just won't go down. Even though, as Phil Lowe said, who's the Deputy Governor of the RBA, said last week that the Australian interest rates are as low as they have been historically, which of course they are, at least in terms of modern banking, we're still quite high relative to other countries. And that being the case, there is still some pickup. And then some of the other indicators and change in perceptions towards Australia and China in particular mean that, you know, there's other reasons why people are buying the Aussie, and that's not going to change. This is important. It's a big change. I started in financial markets back in 88 and started trading in I think 1990, and you know, rates went down, so I like markets that fall, and every time the world growth's got weak over the last 20 or 30 years, the Aussie's fallen. So last year when the Aussie got down to 95 cents, I was sure it was going under 90, so a bit of egg on my face there, and I didn't think it'd get back up through 102, and clearly it has. So what is changing? You know, clearly it's about something else, and it's that interest rate as well. But if we have a look at just a little bit more history, that old world that I talked about, that's the NASDAQ on the left-hand side. We were viewed as old world. You know, the NASDAQ rallied and then the NASDAQ sold off. We got the worst of the NASDAQ rally and then we got the worst of the NASDAQ sell-off. So we were old world and then we were a risk asset. That's the way the Aussie always used to travel. You know, if you look at the Asian crisis or the LTCM crisis or you know, the 2007-2008 periods, the Aussie fell out of bed pretty quickly. But since QE has come in, and obviously we're up to QE infinity now, the Aussie's been doing well. And of course that's because zero interest rates around the world are causing people to put their money in riskier assets. So there we've got interest rates, we've got investor sentiment, and investor sentiment's really important because it's global investor sentiment. And one of the things that I would say to you all here, and I'll reiterate later, is that unless or until equities fall out of bed, the paradigm that says the Aussie is going to be stronger for longer is not going to be threatened and hardly questioned. If China crashed, or if equities fall right out of bed, and I'm talking S&P 500 below 1350, then, and maybe even lower than that, then that would probably be required for the Aussie to materially move down through 101.50 or 1. There's going to be a lot of buying down there. So we've looked at commodities, we've looked at investor sentiment, and we've looked at interest rates. Now technicals, we all know technicals. Hopefully that's a chart that you can see. All I'm showing here, anybody who trades Aussie knows that technicals are important, but you can see here back in the 2008 to 2010 period, that if you were just using a really simple trendline analysis with moving average crossover, you would have made a fortune. Back in the late 90s, I was actually given the turtle system when I first started trading back in 1990. A mate of mine had it, and it used to be the case that every time we had a 2-week break, or a 20-day break, that the Aussie would either rally or sell off. Now that doesn't work as well as it used to. Hasn't done for a few years, and certainly hasn't done since about April or May 2011. But we can still see that people are trading technically. My moving average crossovers, whether they're on my monthly charts, my weekly charts, my daily charts, my 4-hour charts, or my hourly charts, even all the way down to my 5-minute charts, I don't go any smaller than that, tend to work really well, as do trend lines and as do Fibonacci's. Now, why does that work? Some of you may not like technicals. Most of us who trade for a living recognise that whether they work or they just happen to be watched by a lot of people, they do work. But this is another thing. So if Aussie breaks big key levels, and we'll talk about one of those later on, then there's going to be a lot of people piling because a lot of people are watching it, which I guess is the key thing. Also, what used to be important were speculative positions. I remember back in 1999, I was one of the first people to start looking at this, and you can see, like many of the charts I've shown you so far, that the commitment of traders' speculative Aussie futures positions worked pretty well as a proxy for the positioning in the Aussie, but also for where the Aussie is going to go. Now, if we have a look here in this period here, this June 12 period, you can see the Aussie did react, but nowhere near as much as positioning did, which is uncommon. If I was to show you a chart of Euro against speculative positioning, you'd see that the correlation has remained strong over this period where it's broken down substantially with the Aussie. Now the US dollar, obviously, how can you ignore the US dollar? It sets the global backdrop. It's on something like 90% of all other trades or more, and as such, whether the US dollar is weaker or stronger will have an impact on what the Aussie dollar is doing. So what we've seen recently though, and if we look at the US dollar index on the right hand side, which is the red line inverting, you'll see that the Aussie once again has held up much better than expected. Now that's manifesting in cross rates. Euro Aussie, Sterling Aussie are under substantial pressure. Aussie yen broke out this morning, although it's reversed today. And Aussie on some of the other crosses is doing really well because it's so much stronger than its usual relationship with the US dollar would imply. It used to be that it was a high beta trade on the US dollar. Now it seems to be a low beta trade. So they're the key 5 drivers and how they look and how they've changed. So what has changed? I guess I think about this all the time. I sit in front of a machine trying to figure out what's driving the Aussie, what's driving the Euro, what's driving other currencies every day of the week. And when I put this presentation together, those orange lines just kept creeping up. And the one thing I can put it down to is Greece. Greece in May of 2011 was when we really kicked off the part of this crisis that said to investors that this was a very different cycle. Up until then, the easy gains that came out of the 2008-2009 G20 arrangement that they were going to save the world, now everyone's trying to save themselves, had started to wash through. We'd had a mini spurt back in May 2010, but it looked like Greece had kind of gone away, and then it came back with a vengeance in April, May of last year, and that's really when everything changed for the Aussie, because that's when we started to diverge in our overall general direction from the euro. That's when the market realised that Carmen Reinhart, and Ken Rogoff, who wrote that fabulous book, This Time It's Different, Not, and then followed up with an academic piece showing that once you get to a certain level of debt, it's pretty hard to get out of it. The market realised this for Spain, for Italy, for Greece certainly, and for Europe more broadly. And on that basis, I think what happened is people started to look at sovereign ratings, and of course everyone was getting downgraded. Australia is one of the last few AAA rated entities. People started looking at relative interest rates, people started looking at relative growth, and the substantial benefit of the mining boom, of high interest rates, of a relatively strong economy, of a fabulous central bank that's kept us out of recession for almost 22 years now, and of a fiscal situation in Australia that is really, quite strong. We down here like to talk about the fact that households are deleveraging and they've got pretty a large lump of debt on their balance sheet, but the reality is people offshore, they just see the macro settings, and the macro settings for Australia relative to everybody else are really important, and this is where everything changed. So the last 18 months is very different to the previous 27 years of the Aussie's float. I almost choke if I say safe haven, so I'm going to say safe harbour, but I think that's also important, because if we think of the Aussie as a safe harbour, then when the storm passes, you know that you're going to go back out to sea. And I think that's really important. So I see this as a long-range cyclical shift as opposed to a fundamentally rock-solid structural shift. Because at the moment, where else would you want to put your money? The key thing, of course, is that because central banks and sovereign buyers have been buying with such gusto, they're not going to be spooked out of the Aussie in the way that the speculative community used to be. And you can see that when you look back on that Commitment of Traders report. So, how do we deal with the future? That comment from Phil Lowe pretty much sums it up, and that's what it's all about. It's all about interest rates. It's all about a safe harbour for your assets. It's about knowing you're going to get your money back, and so that's the key to the future. When the globe starts to heal, and I don't think it's going to be for another 5 years at least, but when the globe starts to heal, money's going to flow out of Australia, but it's not going to happen yet. When I was treasurer of the bank I was treasurer of, one of the things that happened is that at the depths of the crisis, money came to my institution. Indeed, it went to most Australian banks. And the reason for that was people got scared and they wanted to make sure their money was safe. The worst possible thing, the thing that used to keep me up at night as treasurer, was what happens if the sun comes out. Because if the sun comes out and that money leaves my balance sheet and gets deployed into equities, into housing or something like that, I'm going to have a hole in funding. That's the same situation for the Aussie, but it's not going to be a concern for 3 to 5 years at a minimum. So, as we all know, trading being in cash is a position, but you're also getting a good pickup here for Australia. So I think the Aussie is going to be stronger for longer. And as I said, while the GFC persists and the Australian economy does pretty well, the Aussie is going to remain well supported. So if we have a look at what the 5 drivers, positives are now negatives, because it's partly the case that the weakness globally is actually driving strength in the Aussie, as opposed to the historical norm, which was always the opposite. So while our growth profile certainly weakened, and the RBA is cutting, when it has to, the reality is that we seem to have a bit of a barbell in global markets. Lots of people are in equities, and equities are doing well, but there's also safety in Aussie bonds. And if we look at the technicals, which we will towards the end, they're going nowhere. So the risk of getting flipped out is pretty low. So even while the US dollar starts to strengthen, and I think there's a good US dollar rally coming, the Aussie's going to outperform on the crosses pretty materially. Now, I'll go backwards a little bit to China. I wanted to put this chart in because if you have a view on where the Aussie's going, you can really tie it down to what's your view on China. Now, this is a fairly old chart, but it was presented by the RBA back in 2010, but you get the idea. Look at where that red line starts. Where that red line starts is when China joined the World Trade Organization. The correlation of Australian growth to China went from maybe 0.1 up to 0.5, something like that. So where China goes, so goes the Australian economy. They take roughly 25% of our exports. Now, a lot of it's rocks and dirt, so, coal and iron ore and things like that. And, of course, we are seeing a supply response, and prices have fallen recently, and that sort of thing. But to the extent that China is looks like it's instituting a soft landing, Australia is going to benefit from the positivity that people still feel towards China. Now, of course, we're about to have tomorrow a change in the Chinese leadership. These leaders are going to be tasked with trying to move from an export-orientated economy to a domestic-orientated economy. That's a big task. But to the extent that the RBA believes in the China story, and that everyone else believes in the China story, and that the new leadership in China can institute a reasonably soft landing, as we're seeing now, then we're going to continue to see Australia benefit. Now, one of the things that we discovered at Lighthouse and Global FX is we like to look at the the Chinese leading indicator as a proxy for Australian interest rates. And obviously you can see on that chart that the yellow line has become more closely correlated in directional terms with the red line, which is the RBA cash rate. So that's Chinese leading indicator and the RBA cash rate over the years as that correlation has strengthened. I'd probably argue that if you were at the RBA and you saw this chart, and of course they know all about this relationship, that's one of the reasons why they didn't cut yesterday, when I think they probably should have, given the weakness in the Australian economy. But we're not far off where we should be in terms of interest rates, given our relationship with China. And I think the RBA knows that. So that being the case, rates are not going to fall much more than maybe the 50 to 75 points the market's factoring in. And if that's the case, then there's no negative surprise coming for foreign exchange markets. It's baked in the cake, as they say. So it's hard to get the Aussie, knock the Aussie down on that basis at all. So I think that's really important. And if we talk about where China's going, you would have all seen the HSBC PMI, you would have seen the standard PMI, and it does look like China is basing. This is just a simple leading indicator chart versus year-on-year GDP. And obviously what we're seeing is we're seeing China base around that 7.5 region, which is of course what they were looking for. And as such, I think you've got to say that if they can pull this off, which for the moment they look like they're going to, then the glow, the reflected glow of that is going to benefit the Aussie's profile in terms of least ugly contest and where it sits in people's portfolios. Certainly the central banks aren't going to change. Also, their view, and global portfolio investors will continue to buy. Obviously there's a limit, and the marginal player sets the price, but shorting Aussie for anything other than a short-term trade is fraught with danger unless there's a good reason to at the moment, and you want to be nimble about it, which of course is very different to the past. So, equities. I still think that, as I mentioned before, while ever the S&P 500 stays up, then the Aussie is, going to stay up. You could argue, if you only looked at one chart in this pack, you could probably argue that maybe the Aussie dollar's underperformed. Of course, I'm not arguing that at all. But I think that, from my point of view, the risks to the Aussie have to be topside unless equities crash. The 105, 50, 60 region looks quite strong at the moment, and I'll talk about technicals in a sec. But realistically, while equities are still doing okay, the Aussie's going to do okay. If equities turn, my view on the Aussie will change very quickly. Obviously, I apologise for the ugliness of this chart, but I had to borrow it from one of my other websites, which is Macro Investor. It's an Australian-based investment newsletter. People are talking about the RBA intervening. The RBA likes a free float. They won't intervene, they can't intervene, they're not big enough. And there's certainly no appetite in this country to do what the Swiss National Bank's done. We know that all that would do would be to make it difficult for the internal economy and change the interest rate profile, which is not what the RBA wants to do. What they have been doing, however, is they've been slowly building a war chest. The selling of Aussie that they do to other central banks and to sovereigns has not been sterilised in the market. So over the last 3 months, they've taken onto their balance sheet over $1 billion in foreign reserves, which is more than the previous 10 months combined. And the last time they built up anything like that was when Aussie was at 1.1 back in last year. So clearly, they don't want to put further upward pressure on it, but equally they're not going to intervene. The good thing is that in building up foreign reserves, and they've probably built up 2 or 3 billion over the past couple of years, is that when the Aussie does inevitably fall out of bed in some point in the future, they'll have plenty of money to test and smooth the market. So they're the key things. equities are holding up, Aussie will hold up. RBA is not going to get in the way. They won't help it higher, but they're certainly not going to intervene, and China. So they're probably the key drivers of the outlook going forward. Now what does that mean? That means the Aussie is going to be stronger for longer. Now if we look at the technicals, this is today's chart, done early this morning, so we don't have a print for today, but Aussie pulled up last night at 104.44. That's roughly 61.8% retracement. If it can get through there, 105.65, which is the convergence of these two lines, you'll see those in a sec, is major resistance. Now, a chartist friend of mine I was talking to just this morning, he thinks a breach of 105.65 opens a move to that 115 kind of region. Certainly it opens a move towards the highs of last year at 110, but we'll have to see, because the high at 110 was a very, very old 30-year Fibonacci level. One of the key things I think for anybody trading the Aussie from a technical point of view, and something to watch, is that the average true range is tiny. On a daily basis, it's the lowest in over a year. Now, that means if the breakout comes, you're going to have a big position on. But it also is a warning that for me, I'm a Minskyite. I believe stability breeds instability, and certainly my 25 plus years in markets have shown me that. Some of the best trades I've ever done were when the market transitioned from low volatility to high volatility. It may not be the time yet, but certainly a low volatility environment with equities holding up is good for the Aussie, but if equities were to turn down, you'd see that volatility spike pretty quickly. Equally, a good news, and we could see a sharp move higher. So that's a really key input, I think, when you're trading Aussies. Keep your eye on some sort of volatility measure. Those of us who are in the retail market these days probably use ATR as the best indicator, but if you're a wholesale trader, then obviously you can look at options vols and get a really true read on it. In terms of the weeklies, there's that downtrend line. 105.65 is where that blue line up here is. If we break through there, then it's off to the races. And then monthly, what a mess. It's a huge uptrend still. My indicators are still long from that. I wouldn't expect it to break that line just yet, but the momentum's fading. So what does all that mean? I believe currency markets are least ugly contests, and the Aussie's Cinderella at the moment. So the weak global backdrop means that Aussie still stands out as a good risk return. Anything down to parity, maybe a little bit under, is going to continue to be big, given the current settings. Whatever China's doing okay and equities are doing okay, the Aussie's going to do okay. So we've got a safe harbour status. Of that I have no doubt. Safe haven I don't buy. We're not Switzerland and we're not the US. When the sun comes out in other countries, I should say, the Aussie will start to lose some of its glamour. But the reality is that that's going to take years. There's at least 5 more years of this mess that we call the global financial crisis down here in Australia. And so that to me says that probably the outlook for equities is weaker at some point, and with it possibly the Aussie. But whereas I would have said, 5 years ago the Aussie was a 65-85 bet, you've probably got to say it's a 85-115 bet going forward. So my bias is that I want to buy dips. I can't help myself. I'm 50% trend following and 50%, just the process based on my MACDs, my ADX, and my moving averages. So I'm always going to try and sell in front of trend lines and those sorts of things. But for the moment, I think it's going to be stronger for longer. Now that's where I was going to finish up. I know I probably over-talked by a few minutes. Did anybody have any questions or comments or anything that they wanted to talk about? My pleasure. Thanks for turning up. I hope I didn't talk too much. Cool. Oh, I think I did a piece at Macro Business last year. I couldn't find it. I wanted to talk about it. I did some really, really long-term technicals. Thanks, Ivan. Yeah, you can. I can envisage a market where Aussie sails through 110 and gets to 120 on really long-term technicals. I could not deny that at all. As an extension, I don't have the long-term chart. Let me just see if I've got it here. I don't have the long-term chart. Let me just check with my other monthly. How long will it go? No, without Bloomberg, I can't go back far enough. But I will have a look, and maybe I'll talk about it in one of the posts. But there is an argument that says Aussie can get well into the 120s. And I must say, whilst fundamentally that would cripple the Australian economy, as somebody who, believes in the market and that, prices pretty much tell me everything, I will, go with that view if we see 110.80 break. Whereas some people believe that 105 is the catalyst for a substantial move high, 105.60 that is, I would prefer to see it through 110, 111. The preconditions for that are not there at the moment, but that's not to say they won't be. The Reserve Bank has done 22 years without a recession, and if the globe slows down and we keep going the way that we are going, notwithstanding all the bearishness from some of the pundits here in Australia, there's no reason. What's my favourite indicator? I don't have a favourite indicator. I have a group of favourite indicators. Let me just bring my chart across onto this screen, and you'll be able to see. Okay, can everyone see that? That's my that's the trading platform I use. I use a combination, and I've been using this combination for a very long time now. MACD with the histogram. That speaks to me. The ADX is something that I've just started to use. When it gets above 22 or below 22 for either the positive or the negative, that's a good signal that we've got momentum. I use the ATR as my volatility measure for my position sizing, and then I combine those with Fibonacci ratios and trend lines. It's all a bit sounds a bit messy, but it's actually a very solid process, which I'm just trying to turn into an expert advisor. I used TradeStation for years, and I've only just started using MetaTrader in the last 3 months, so I don't exactly know how to code yet. But I'm going to. I built some systems which look pretty good. I also like to use moving average crossovers. So if that you see there on the screen, that's what I look at in every single time frame and on every single currency pair. And it doesn't matter whether I'm looking at my my 1 minute chart or my monthly charts. That's my process. And what I do find from a technical point of view, in the same way that my fundamental process, it's fractal. It works multi-time frames. So that's quite positive. But if you had to lock me in a room and say, just give me one indicator, I'd just take the MACD with the histogram. Was there any other question? Yeah, I think the RBA is going to be forced to cut, and that obviously I don't know where the messages are popping up. Ivan, sorry, but thank you for posting those. Yeah, I think rates will go to 2.5% in Australia. Australia's in the grip of the deleveraging cycle. That's been papered over by the mining boom part 2 for the last few years. But as that investment boom wanes to a certain extent, so the ability of the Australian economy to where the interest rates where they are is lessened. The key problem with Australia is that mums and dads just have too much debt. In 1996 we had 50% household gearing. Now we've got 160 odd %. I think we're pretty much the only country on the planet that that saw here it is. I'll just bring this across. This chart here. This is our debt burden. So we're still under that. Now, sure, interest paid has come down a little bit, but Australians have got too much debt. This is going to take years, and we're all getting older, and demand for credit is at its lowest it's been since records were started back in 1975 or 1976. So, yeah, the RBA is going to have to cut again, and probably to 2.5%. But it won't go any further than that, I don't think. Anybody else? Okay then. Well, if that's all the questions, can I thank you all once again for your time today, and I'd like to thank FX Street as well for asking me to do this. You can catch me on Twitter at FX_global, or my website, which is open for today and tomorrow before we put it back behind the wall and try and finish it off, is www.globalfx.com.au. My details are there, so at any time I'm happy to connect and talk about currencies. Besides my family, it's my favourite thing to do in the whole world. I love this trading game, and you know, it can still let me live 200 k's from the city. So yeah, it's all good. Always happy to talk. So there's the address. Ivan's got it wrong. It's globalfx.com.au. That's all right. That happens. Okay. Well, I guess we'll close it up there. And thanks again. And hopefully we'll see you for the next webinar.